Assalamu alaikum, sabah al khair. Good morning, everyone. Wow, what an exciting panel I have the honor to moderate today. Thank you, Michael, Amar, and Bushra for that. So let's dive straight into the topic of institutional trust with you next to me, Michael. Tell us a little bit how the evolution of prime services and clearing has changed the institutional assessment of counterparty risk, especially since the year 2022, and why 2022?
Sure. 2022 was a tumultuous year, actually. It started off with UST Luna crashing, then was followed by 3 Arrows default, and then the wild unsecured lending market blew up, the Celsius and the BlockFis, and it ended pretty spectacular with the default of FTX. And so that was right at the time as we were establishing one of the first prime brokers and clearing firms in digital assets. And at that time, we were calling out really two issues. The first was that there was this inherent credit risk in the system that wasn't being valued or priced properly, or really priced at all. And the second, there was major challenges around the vertical integration of the exchanges and certain roles and responsibility. Those lines were blurred. And so really two observations over the last few years. The first is that counterparties are hyper-focused now on managing that counterparty credit risk. They're doing that on the run, which is difficult to do. But what do we know? We know that the price to hedge risk pre-FTX was near zero, as folks are willing to pay very little to hedge that risk. We now know it's certainly not zero. But the question is, what is the right price? And it's hard to find proxies for that. The second observation is when these early stage markets develop and mature, we've seen this in other markets. And so the blow up reminds me of 2008. If you ask folks in the room, was it conceivable that Lehman Brothers, Bear Stearns, AIG, Wachovia would simultaneously default on $1 trillion of net liabilities? I think the answer you get is not in my lifetime or there or thereabouts. And so when this repricing of credit happens, it tends to happen suddenly and usually in the absence of any good information. And so that's what's going on now. And prime brokers are there to really, they're experts in managing counterparty credit risk. The big gap that's still left is what we take for granted in traditional markets is financial transparency.
Yes.
Getting audited financials. And to wrap with this point, the definition in traditional markets is regular financial transparency on a monthly basis according to GAAP and IFRS, and we're just not quite there. But the good news is I'm a glass half full guy, and we're making progress.
So in a nutshell, would the panel say that there is more trust today than in 2022?
I think so. I think what we've seen in the 3 years since then is more trust. And the reason institutions are coming in is because I think there is a little bit more of an ethos of law is law rather than code is law, right? So we rely on code to be correct and to work our technology, but we also rely on contracts and agreements and relationships, and that's a very traditional finance kind of point of view. And so when we look at some of the things that have been developed at Copper since then and across the market is a lot around counterparty credit risk, and to the credit of what Michael was saying, there's things that allow you now to pledge your assets from your custody account so that you can get the trading capacity you want without having to necessarily lose control of your assets. And that putting that into a legal framework rather than a code framework, that it's going to survive bankruptcy and a court looking at it.
Would you agree with that, Bushra, at Galaxy? And what are some of the remaining big trust issues that remain to be solved?
I think what's interesting here is we are still in a very emergent technology type asset, and we're all still building. We're talking about trust, but there's a lot of fragmentation as well. Something that a lot of players in this space are adapting and working towards. For instance, as you are investing or trading in the liquid asset space, you have to be comfortable going over centralized exchanges, OTC counterparties, and being able to trade on chain. So the fragmentation itself is by design, given how nascent the space still is, and not a bug in the system. The second layer to that is the liquidity itself and its portability. And once we are past that stage, we would have graduated to what I would call longer duration money and much bigger players in our space. For instance, as we're talking about margining and counterparty risk, I don't think it's sustainable for counterparties to put margining across 10 venues. And once you're introducing prime, and I have my colleagues here, touching on that, coming specifically from a traditional finance background that used to trade rates before. And the way we look at it, you look at a central place where prime, basically, like where your credit is centralized and you're able to trade in all these venues. So the trust is not really the problem anymore, in a sense. It's more being adapting basically to the fragmented liquidity in the space, that where we graduate from that, we're going to be in a much better shape.
That brings us to the next topic of liquidity fragmentation versus consolidation. Michael, now from your point of view and in the trading space also, what are some of the biggest issues there? How can we improve liquidity mobility and make sure this happens at a very fast pace?
Yeah, just to piggyback on some of the comments made, I sometimes think folks think fragmentation is a negative thing. In fact, fragmentation for prime brokers, when that's a theme, tend to do very well, as the large trading firms, as they thrive off fragmentation and global pricing. But I think you need to unpack it one layer below of what products perhaps fragmentation will happen and where there'll be consolidation. And so I kind of broadly break them into three groups. The spot market, one of the characteristics about spot is that it's fungible. And so if the parallel I think of is the foreign exchange market. I can buy euro, dollar, yen from the Deutsche, Goldman, and Barclays, and give up those positions to a prime where they net and settle. That's a big driver of that market. And due to fragmentation, you get more specific pricing. So I think digital assets follows that path. Derivatives are different. That characteristic doesn't have that fungibility, right? And so due to that, a futures contract on one exchange is not fungible with the other. And so those tend to flock to central limit order books. Yeah. And I think the winners of those will be the ones that lean in on financial transparency, regulations, balance sheet, et cetera. And then on the last side of it, the security side, broadly ETFs, ETPs, and digital asset treasury companies, those will be global across different exchanges. But the key is, as a institution, you largely have a fiduciary responsibility to source best price. And as mentioned, through fragmentation, one of the keys is to have credit to them. And a lot of the ways you do that in traditional markets is through prime brokerage and clearing.
Amar, let's talk about stable coins and tokenized cash here for a moment, as well as you are one of the experts here on the panel. Now, from an infrastructure and custody perspective, how does the regulatory environment look like, and how do you see tokenized cash develop and evolve from here?
Sure. I would never consider myself an expert in anything, but I appreciate that you call me one. I think it sort of touches on the topic of fragmentation. Right now, we're in an early stage of market development. And so you'll find that there are almost an infinite number of different ways of transferring cash, what would be fiat currency, on digital rails, on blockchain-based rails. And so some of the unlocks I think that are needed there is a little bit either of consolidation and some larger user bases that consolidate around 5 or 6 different ones for different currencies, or some fungibility between them and some mechanisms in which you can get that fungibility. So I think that those are the things that right now are somewhat hampering the market. And obviously regulations around, can cash pay interest, or does it have to pay rewards? How are those rewards paid? These are some of the still debates, even in the US, where the Genius Act tried to clarify what stablecoins actually are. You still have a little bit of open questions as the rulemaking comes out. So I think those open points are still early stages for developing that marketplace and that product.
Yeah. If we stay on the topic of stable coins, Bushra, a lot of institutions are using them now as a collateral settlement as well. What are some of the new rules, regulations, insurances that we need to really, make sure that they are also, guaranteed?
Yes. Piggybacking on that, I think stable coins will be treated as high quality cash once a few kind of data points come to the system. Number one, obviously, the transparency on the reserves.
Yes.
I don't think monthly audits cut it to treat basically stable coins as what we call high quality cash, which is basically cash repo treasuries in the traditional financial markets. And I think once we solve for that, that would be a great graduation for stablecoins. That's number one. Number two is the operational hurdle itself and how they're treated in balance sheets. There needs to be very specific clarity when you're treating collateral versus custody and what you're pledging against your margin in basically derivatives. So a few operational hurdles that we go through, but I think number one is the transparency on reserves and having these on real-time basis would make them high-quality cash that will be treated pretty highly as, this, I would call high-quality cash that we're all craving for to be able to trade 24/7, which is the North Star of everyone sitting in this room.
Yeah. If we stick with liquidity for a moment, Michael, what kind of changes do you think will be necessary to improve the situation in the market?
Sure. I think there's, to draw a distinction between crypto trading and tokenized finance. Those are largely different things. And I think kind of the next wave that we're really seeing is tokenized financing. It might not be as exciting, but the unlock there is pretty material. And so I think, zooming out, anything of value starts to get tokenized, being put on chain, perhaps in smart contracts, better specifications in those, and using that as good settlement or margin. Something like tokenized repo is incredible. In the US, you have CFTC Commissioner Pham coming out with the formal announcement of tokenized collateral and stablecoins. This starts to move traditional markets to 24/7. Makes those better marketplaces, more trading opportunities. So we're at the very, very early stage. I'm a baseball guy. It's probably the second or third inning. So we have a long way to go, but exciting.
Yeah. If we zoom out for a moment, and as we are all global citizens, one of the things that I'm worried about personally is the digital gap in the world, right? I mean, we speak here about tokenization and stable coins and everything, but there are a lot of countries in the world, which don't have access to these tools. What is your outlook? Do you think that there will be more globalization of these assets? Do you think that the digital, divide in that sense will widen, and what can we do about it?
Directed at anybody? Or
anyone?
So I think what we're seeing really with stable coins as a starting point, but I think moving on to other tokenized assets is that globalization, right? You're one of the reasons I think the US government switched such a dramatic 180 on stable coins is that they're largely exporting the US dollar to be used as a reserve currency in many economies where they wouldn't have had access to the dollar if not for stable coins. And that obviously that helps the government fund itself, that helps creates a bit of political power in the world. And so I think that globalization trend is going to continue as equities get tokenized. And now during the middle of the New York night, somebody in Asia can trade stocks that are listed on the New York Stock Exchange in a tokenized form on some trading venue that has the approvals to do that. I think that now has made a global stock market that can run 24/7, not just from the venue in its original location, but really having trading counterparties around the world.
Yeah, and a lot of digital asset companies like yours are also looking east, obviously, expanding from New York and London, now more into Abu Dhabi and Asia, Singapore, Hong Kong. Do you have any specific plans to launch operations around the world?
As of today, Galaxy announced the opening of its office in Abu Dhabi. In ADGM. If you guys have any questions, I will be leading the office there, here. We're very excited. It's not only an Abu Dhabi play, it will be a MENA play. Very excited about the region and how we can partner with the region as well. We see a lot of players keen into working together on making this space go much further where we want to see it. So thank you.
Fantastic news. Wow, we need to celebrate afterwards. Michael, for you and your new company, your new baby, any plans to set up shop elsewhere?
Yeah, certainly. So we're pretty global in nature already. I just did a trip in the Far East, and so I spent some time in Korea, and that market's pretty interesting. It looks like there'll be two ETFs that come out, Murray and Samsung, but there's more clarity around institutions coming in there. If you spend time in Tokyo, the JFSA is changing the regulatory leverage ratios, and historically, when those leverage ratios change, there's a pretty material impact, kind of elasticity into the trading volumes that go through. We've also set up shop here as well, and the FSRA is one of the better regulators that get it. And I think just on a global basis, the regulators do take a lot of cues from the U.S. And as Amara mentioned, the U.S. is kind of behind it, and so we're starting to see most major financial destinations get behind it. I'd say the one challenge of that is you still have ambiguity between each of these regions, and so spending enormous amount of time and resources in navigating and mapping those, but overall, broadly, exciting.
Yeah. Any word from you, Amar, in terms of global expansion?
We have an existing entity here that we're expanding in terms of scope and size, and echo what Michael said about how the regulatory environment here probably even preceded the U.S. in having a lot of support for innovation and for expanding blockchain-based asset trading and custody. And so I think we see this as a key part, this area as a key part of our strategy as you create a global business, because we do have to cover 24/7 time zones.
Yeah. What are some of the new market participants that you see joining, the digital assets market? I mean, we have sovereign wealth funds, we have banks, insurers, private individuals. Which are some of the untapped potential clients that you're looking out for?
So I wanted to take that one. So banks are mega selling machines. And we're very excited to have banks in this space. It was the best thing that happened to us with better regulations coming into our space. Now banks are not shying away from building the rails that will bring what, again, I keep referring to as the long duration money. Sovereign funds and mega managers want to participate in the space. They got some regulatory clarity. Now they need the rails that work within their custody needs, their regulatory framework needs that are going through, and that could be adaptable across these platforms. So we're very excited to have sovereign wealth funds coming through and mega managers, and we're very excited to having banks selling the product to the space.
Because we just have 2 minutes to go now, I want to ask the crystal ball question. So if we look through it for 2026, what is your prediction in terms of market growth and also opportunities for ladies first? Sorry.
I do not have a crystal ball. However, I'm very excited about generally bringing more tokenized treasuries into the space. Yeah. We think having that in place in clean, proper rails that are potentially being used by the bigger players would create a lot of liquidity, which means less volatility in our space. Being able to have 24/7 immutable, continuous collateral is huge to bring this space to another level of maturity.
Yeah, less volatility. That is important. No more 2022. Amar?
I think volatility is actually good. Most market participants like volatility. It's the discontinuity with volatility that is not good, right? FTX was a 100 to 0 in a matter of minutes. That's hard to hedge. Yeah. But I think 2026 is the inflection year for this, not only this industry, but for the technology, because we're seeing all the incumbents from the financial markets really having spent the last 3 years or the 3 years prior to this year putting all of their projects in mothballs or ice, now really restart and announcing projects that are going to launch next year, or resuming the services that they had been providing that they pulled back from under a different administration in the US or during crypto winter. And I think when you start using blockchain rails for all asset classes, that also has a knock-on effect on the crypto markets, where crypto is valuable mostly because it is the gas that fuels the technology. It is how you pay for transactions to get recorded on a blockchain. And so for most of these crypto assets, more use through the spreading of the technology is going to mean more value to the underlying crypto.
Last but not least, Michael?
Best for last, I think, right? I would say, just kind of piggybacking on what was already said, but I think, again, the tokenized finance side is where we unlock from here. The tokenized finance has outpaced the connectivity tissue, though, and so we really need to focus on the integrations between the modern blockchain technologies and some of the legacy systems to really to unlock again. But no doubt the resources are here, the regulators are behind it, the big capital's behind it, and we're excited to be in regions like this that see the future. So excited.
Fantastic. And of course, 2026 will be the Chinese New Year of the horse. So I hope that everybody is going to race ahead full power. Bushra, Amar, Michael, give it up. Thank you so much.
Thank you.